Have with us Mr. Ajith Kumar Rai, as promised, the founder and chairman of Suprajit Engineering, to talk to us about their earnings performance. Mr. Rai, hi. Thanks so much for making time. Well, the earnings this time around was a decent show because the revenue was up just around 5%, but at least you've managed to show a good margin improvement, and that's why the profitability is high by 32% on a year-on-year basis. But Mr. Rai, my first question to you is on the margins itself. Though year-on-year we have seen a decent improvement to 10%, your historic numbers have been closer to around 15-16%. When do we see those numbers back as far as margins are concerned?
Thank you for having me on your channel. You are right. On a quarter-on-quarter for the yearly basis, the margins have improved quite nicely by almost 32%. And the margins at this moment is at around 11%. Historically, we are at about 14%. I think the difference between the gap has been largely due to our controls division, where as you know, we had acquired the LDC entities last year. And that has been one area where we are continuing to improve our margins. Added to that, the non-automotive business globally, being a discretionary item, had seen a significant fall in the volume. So that has been the two reasons why the revenue growth has been somewhat muted. And that has affected in margin for the quarter. But going forward, we have seen that we have significant new business wins. And we have given the guidance that we will be between 12 to 14% in this year by end of the year on a consolidated basis. I'm pretty sure that we'll be able to meet the guidance that we have provided. This is just the first quarter, which is typically seasonally weak quarter.
Mr. Rai, I understand that the two-wheeler part of the automotive, and even if you take into account the OEM and aftermarket, still has a reasonable exposure of your overall revenue pie, though over the years you have diversified your revenue pie very nicely. I want to understand what's the outlook when you are in discussion with your large clients. At least when we speak to your large OEMs on our channel independently, they seem to be painting a picture which is much more improved compared to how last few years are. So will that start in the second half itself?
I mean, just to give a macro picture to you, in the first quarter, the two-wheeler industry per se has grown only by 1%. And also to give the macro perspective from a historic perspective, two-wheeler industry at the current strike rate is far below the pre-COVID peak of 2018-19. So we are still behind the curve. Yes, there seems to be some green shoots, and they're hoping that post-monsoon and with the festival season around the corner, the numbers will improve, which is good for us as well. So I still think that the two-wheelers have some more work to do in terms of increasing the volume and increasing the penetration, particularly in the rural market. Having said that, as you rightly said, our dependence on two-wheelers is at less than 25% today on our overall sales. So it has a limited impact on us, but yes, it is some impact. And we expect that the two-wheeler industry will continue to have a challenging year going forward. One is because of the ICE engine issues being converted into EV, even at the EV level, the FAME-related issue and the new subsidy clarity, all these things are uncertainties. So I think once our uncertainties are behind us, I think we will see a very good traction in this segment.
I wanted to come back to the point that you were making at start about, the non-auto volumes dipping and the reason of the revenue decline, and part of it is global-led as well. Talk to me, when do you see the recovery in your global business, whether it's your Westcon client or what's happening in the LDC business in China? What's the timeline for recovery when it comes to the global business drivers?
On the global business, which is outside of India business, there are two main portions. One is the non-automotive side of the part and the automotive side of the part. On the non-automotive side part, whether it is Westcon or an LDC, we have seen, as I said earlier, a significant drop in business, largely due to people's reluctance to buy discretionary items. To give a specifics, a power sport vehicle or an outdoor power equipment, people are not willing to make that investment where a lot of our cables are going. They're all waiting for the things to change for better in terms of inflation, in terms of economic recovery. So I expect that part of the business to continue to be somewhat tough for this quarter as well as the next quarter. By the time, I hope that will improve. Whereas when I come to the automotive part, which is the larger part of our business in the out of India business, which is now almost comprising 40% of our overall business, I think that's where we are seeing a significant traction. Although global economy is struggling and the automotive business is not growing in the manufacturer side, we are getting significant new tractions. In fact, we have made the announcement this time on the business wins, which shows that despite the market weakness, we are winning large individual contracts with significantly large customers. So we are seeing a huge traction in that side of the business. So put together, we still expect to have a comfortable double-digit growth in the controls division globally going forward.
Talked about double-digit growth in the controls business, but what about in a consolidated business? What kind of growth are you envisaging for FY24?
I think we'll see the same thing. If you look at it, even in our Phoenix Lamps division, we expect a comfortable double-digit growth. We expect, of course, on the electronics division, although it's starting in a very small base, we'll see a significant new business that is getting added. So I think the domestic cable division, the cable side of the domestic business, will also go into some, at least a decent number. So overall also, we expect to have a double-digit growth.
Right. All right, Mr. Rai, thank you very much for joining us on the show today. That was Suprajit Engineering